Good morning, everyone, and welcome to this webinar on pricing and risk management of power purchase agreements for renewables. In this webinar, we will be looking at case studies of applying risk management methodologies to wind and solar PPAs and how tools by Lacima Analytics provides the ability to value PPA structures as well as calculate risk exposures for both hedged and unhedged portfolios. So let's get into it. So your presenters today, my name is Viviana Ciancibello. I am a senior business developer at EEX. I have over 12 years experience at EEX, and my focus is on adapting the power derivatives product suite to the increasing impact of renewable energy capacity in Europe. Chris Strickland is the co-founder of Lacima, as well as the co-author of a number of books on energy derivatives and implementing derivatives models. And last but not least, Ronan O'Brien is Lacima's head of pre-sales. He has been with Lacima for 8 years, previously under quantitative focused roles, and has worked with some of the most significant global energy players. Starting off with a bit about long-term hedging at EEX. So long-term hedging started specifically in the Spanish power market around 2018. And it was driven by the change in actually the Spanish government, which stopped offering subsidies for new renewable energy and solar assets in Spain. In 2018, we had a lot of demand then from market participants in Spain to use our futures products for hedging of PPAs. But the main difference was that rather than use the shorter term CALs, they wished to hedge longer term into the future, even up to the full 6 years that we had available at that time, since PPAs, of course, are signed on a much longer basis, at least 5 up to 10 years or even more. So that actually kickstarted the trend of long-term hedging. And since then, we have had several deals ranging from 4 to up to 10 years ahead once we launched our Cal plus 10 products in September 2021 for Germany, Italy, and Spain. However, then of course, we had the energy crisis in 2022, and this caused a stagnation of long-term deals since price and especially margin collateral requirements were very, very high and volatile, and this was not exactly the right condition for hedging long-term and trading long-term. However, last year we saw deal flow and volumes rebound, and we had over 24 deals in Spain alone, along with several deals in Italian power. And this shows that once market conditions and especially margin requirements, which you see in the graph on the bottom right below, were more stable, then the market returned to wanting to hedge long-term due to their PPA risk exposures. And just a quick look at an example of a long-term hedge on Spanish power. So here we see that our market participants generally trade a strip of CALs. So this example is a 10-year strip with a flat price and a flat volume that looks like a flat price PPA profile, for example. And a key metric that we always point out in these examples is the initial margin in percent of notional value of the trade. So notional value being, of course, the price and the volume, as this is something that our customers look at even before they register the deal to get an idea of how much the collateral requirements will be. So this has come down significantly over the past year and a half or so since the energy crisis, and has now returned to levels like we see now, which is about 9.8%. However, in Spanish power, for example, about a year ago, it was over 20%. So things have definitely improved there, and conditions have become more favorable for long-term trading. Another important point to note here is that the hedge is done using the baseload contracts, which, as we will see, sorry, are you still presenting? As we will see, is also a way to hedge a PPA profile. So that is it from me. And with that, I will pass over to Chris.
Okay, Viviana, thank you very much indeed. I just have a couple of slides about Lacima, but we have 350 people attending this webinar at the moment, so I'm going to very quickly hand over to Ronan to talk through the bulk of the material. So Lacima, well, actually, I should say thank you very much to EEX for inviting us and hosting this event today. Lacima was acquired by EEX in the beginning of 2022. For those of you that don't know, we are an energy analytics company. I use that term in the old-fashioned sense of valuation, simulation, optimization, and everywhere where those things are used. So our clients typically own and operate physical assets, thermal, wind, hydro, solar power plants, gas storage facilities, oil refineries, pipelines, etc. They trade, as in the case here, they trade long-term structured contracts, tolling agreements, PPAs, virtual storage, etc., as well as more sort of standard instruments, futures, swaps, European, American, Asian options, calendar options, spread options, etc., etc. And so our clients typically are doing two main things: pre-trade deal analysis and post-trade risk management. And so from the perspective of this webinar, we would be looking at the valuation of PPAs, looking at the risk associated with those, both from a market risk perspective, as well as being able to analyze how the various hedges can lay off the risk of just selling the power straight into the spot market. One final slide. The work that we're doing here, this is not a demo of our software, but all of the analysis has been generated by our software. So we have a series of modules within our application that allows people to do this type of analysis. So virtual power plants, PPAs, tolling agreements, valuation and hedging of those. We can fit those into our market risk metrics like value at risk and cash flow at risk, PFE on the credit side. We look at valuation, P&L attribution, etc., etc. So that's where we sit. We're very happy to be here as part of this webinar run by EEX. And so because we have actually 370 odd participants now, I'll hand over to Ronan to be able to talk through the analysis that we've done for this webinar.
Okay, great. Thanks very much, Chris and Viviana. And as both alluded to, today we'll be covering what considerations go into assessing a renewable PPA, what are the key building blocks to such an analysis, what risks are we exposed to, and how can we manage those risks. So firstly, when considering a PPA, the key questions you need to address either from a purchasing side or a selling side is firstly, how's the PPA structured? So is it a financial or versus a physical PPA? Is it structured as pay as produced versus a fixed volume delivery, or also can be a pay as consumed, which matches your consumption demand? How's the risk transferred? Are you taking on price risks through the cost or revenue element sides of things? Are you still exposed to volume risk? And what costs are you paying for a transfer of the risk? And is that a fair value? Also, you need to consider what your role is in the context of the PPA, whether you're a developer and want to lock in fixed revenue for certainty and investment. Are you a bank or investor, lender, utility or aggregator, or are you purchasing it as a simple corporate PPA? And does the above risk transfer best suit your role? I.e., are you left with volume risk? Does that affect your business? Or do you have a process to manage that risk? And then furthermore, drilling down into the details of the risk and their dimensions, do you have an understanding how to best manage the price and volume shape risk to both a seasonal and intraday granularity? And then finally, with all that considered, do you have the tools, the resources, the capability to capture and model the key components that go into your PPA? Or should you be going back to the first step in the PPA structure and perhaps finding a simpler PPA that has more of the risk removed, such as a pay as consumption PPA? So those are all factors to consider at the beginning of a PPA. We'll step now into a particular case, an example to walk through and look at the perspective and all the building blocks that go into analyzing a PPA. Firstly, we'll just set the scene that we're seeing this analysis under the perspective of a purchaser of a pay-as-produced PPA. So pay-as-produced may be more on the more sophisticated end of the spectrum when it comes to PPAs, because as the name suggests, you're just taking from the generation assets the power output as it's produced. So you have to factor in the volume uncertainty that goes alongside that with and how, if you do have other demands or profiles to match, how you can manage those imbalances needs to be considered as well. So firstly, I don't know if you can see my cursor on the screen, but I'll go through our two examples here in our portfolio. So we're looking at firstly a Spanish solar generation PPA. So the generation asset itself, the solar farm, is 150 megawatts, but we're purchasing a 30% stake in that through the PPA. And it's a 5-year PPA length. So as Viviana mentioned at the start, that PPAs do span a lot longer. Just for illustrative purposes, we're shortening it down to 5 years just for the practicality of seeing charts throughout this presentation. To a 5-year scale is a lot easier, particularly if we go down to hourly granularities and things like that. So that's just the basic reason for the PPA length being 5 years. That's starting in January 24 until December 29. And we're valuing it as of the 29th of December. The PPA fixed price itself is 59 euros per megawatt hour. And that here is set against the Spanish power forward curve as of that date. So you can see where it sits along the market curve. So here we've taken monthly average for that forward curve for Spanish power. So it is perhaps quite in the money at the start, but because it's a 5-year deal, you have to consider the whole 5-year term. So it's roughly at the money, or perhaps benefiting the in the money side of things, and that will likely be because generators, they probably offer PPA at bit of a discount because implicitly they're receiving a bit of insurance and certainty on a fixed price revenue stream. So that's why generally you may see PPAs in the money at the front end of the curve. And because there's a bit of backwardation along the curve towards the tail end, that it's generally at the money throughout. Similar for German winds, that's a 175 megawatt wind farm. Again, same time period and a similar PPA ownership of 30%, which translates to roughly 53 megawatt hours. Again, valued as of the 29th of December against the German forward market price curve as of that time. A bit more variation in this curve, but again, generally at the money across the 5-year term, with a slight skew to in the moneyness at the front end. So that's the scene set for our PPAs, and now we want to see what steps we need to analyze and value those PPAs. So we look first at the key building blocks for proper analysis. Firstly, looking at power prices, are we capturing the intraday hourly price shape correctly, and the monthly seasonal characteristics of the price shape. Then with both Spanish and German prices, we'll look into that separately. On the energy source side of things, the solar irradiance levels, the German wind speeds, we'll analyze those and capture the key characteristics of those profiles, of those variabilities, and then combine that with energy conversion rates. So once you have those solar irradiance levels and wind speeds, how do you convert that to energy megawatt output production level? We'll also calibrate and simulate all these time series. So on top of shape and seasonality, we'll also capture volatilities, jumps, mean reversion rates, and apply those to simulations going forward for stochastic modeling assessment. Alongside that, we'll look at the risk distribution and see what hedging products are available to minimize that risk exposure of our PPA. And then combine all of that for a full portfolio analysis and full distribution risk profile of that portfolio. So stepping first through those building blocks in the analysis, we focus our attention on the power prices, so the German power and Spanish power prices. Firstly, we look to capture characteristics of its intraday shape, so looking at historical data, calibrating clear intraday shape profiles and characteristics that we can then layer on to the market forward curve for more detail, because the hour-by-hour basis is important to PPA modeling to pair with the hourly wind speeds and solar irradiance. So you can see here that we've broken down, we're looking at business days here. In the background, we also looked at non-business days, which would be a lot more flat, less interesting, but then we can clearly distinguish between business and non-business day profiles. So we have our hourly shape across the day here and categorized on a seasonal basis, looking at each month's average shape profile. So for example, here for Germany power prices for September, here you can see a clear distinction in a standout profile here with quite variation throughout the day. You have your morning peak and evening peak clearly defined here. And then you have flatter profiles, in this case in your summer periods. For example, your June, the light green here is quite flat. Spain sees a lot less distinguishable profile, and that could be through the characteristics of the Spanish market and perhaps less reliance on heating over winter periods, for example, and less variation in intraday shape as well. You can as well categorize these in different ways. Rather than on an hourly basis, you can do it as blocks as peak and off peak, or rather than months, you could do quarterly or other seasonal components. Or you could even, rather than business and non-business day separation, you could go down to a finer level and do specific for every Monday, every Tuesday, etc. So there's a bit of an art form in your calibration techniques and deciding what breakdown best represents what you want to analyze. On top of the shaping parameters, you can also we also calibrate stochastic model parameters. So these are things like the volatility, the mean reversion rate, jump frequency, jump sizes, and the distribution of those jumps. Again, those can also be categorized. So you could have a peak off peak by month categorization. So volatility for off peak period in June would differ from a peak period in December and have a different volatility, and then those can be imposed on your simulations going forward as well. So with that historical price shaping, we can then take our market forward curve. So here we're looking at the German power forward curve as of the 29th of December, our valuation date. Again, we've cut down the horizon just because we're looking at things at an hourly basis and just for a practical sense to really see the detail here. The dotted red lines are your market quoted base and peak quotes for German power. You can see there's greater granularity in the front end of the curve. So this is your day ahead, week ahead, etc., weekend ahead. And then you have your monthly, your quarterly, and your calendar year all overlapping throughout the curve. So the first step is to construct the blue curve. So this is our daily power curve, which is arbitrage-free bootstrap curve off of these base and peak market quoted prices, and it is entirely consistent with those quotes. From there, we want to get down to an hourly level, of course, because that's where our modeling will take us with hourly wind speeds, hourly solar irradiation. So we then, on top of this blue daily curve, we impose the hourly shapes, which are categorized. So you can see a clear distinction between weekends and not business days here, as well as variation in different months, because we did have different hourly shapes calibrated for different months of the year. So that's your stepping stone from a overlapping market forward quote to an hourly shaped forward curve, and this is still entirely consistent with the market quote. So these are normalized shaping parameters, so therefore they'd average out back to consistent forward quotes with the market. We do the same with Spanish power forward quotes. This time Spanish power is only provided with base quotes, arguably easier to apply the shaping to, but really does enforce the importance of shaping. If we don't have the base and peak distinction in the markets implied, there's therefore more reliance in our calibrated hourly shaping parameters to impose onto the forward curve for the required detail. So up to this point, we've focused our attention on power prices. Now we'll conduct similar analysis that needs to be done on the power generation side of things, both the wind speeds and the solar irradiation. So for German wind speeds, we're looking at a historical 3-year history from a German wind weather station. You can see here that in the final year 2023, there appears visibly to be a lot more variation, a lot more spikes occurring. Again, bringing us back to the point of calibration as an art form rather than a science. So there is subjectivity of which historical data you use. For example, you could just choose to pick the most recent year and calibrate based off that historical periods, which sees higher volatilities, greater frequency and spikes, because you may feel that's more representational of how wind speeds will be in coming years, or you can choose to take a wider horizon and see last year as a one-off occurrence, and this the 2021, 2022 wind speed levels are more on trend with what we see year to year. Again, we look at hourly shaping of German wind speeds. You can see here there's a lot less of a distinguished profile that we see with price shaping with the peak and off-peak. That's understandable with winds being variable throughout the day, but we do see a clear distinction between the seasons there. So much low wind speed levels in the summer months than we see in the winter months. We then can combine all this wind speed information and then have to convert that to megawatt output power generation. There's various ways you can do that. So commonly known as the S-curve conversion rate of wind speeds here across the x-axis to wind generation output megawatt hours on the y-axis, and as you can see here, it resembles the S shape. So this is a regression on historical comparison to wind speeds to wind generation output. In some cases, S-curves are published publicly, and you could use that as your implied conversion rate or transformation, or you could look at if you have access to wind generation outputs and information of wind speeds, you can conduct your own regression calibration and impose your own S-curve as well. Similar process is followed for solar irradiation. It's important that the models take into account the nuances of the different underlying energy source or price series you're looking at. So what is clear and obvious with solar irradiation is a clear and defined intraday shape, which is somewhat deterministic. Obviously, overnight there'll be no solar irradiation levels, and you can predict the expanding distribution shape as you approach summer periods in the northern hemisphere, in all hemispheres, but as you approach summer periods where the daytimes or daylight hours get longer, you can impose that deterministic points there. It's important as well not to sort of just blindly run a calibration, because particularly around these points, if you don't distinguish between months, you could get an average across the board of, hour 7 has a non-zero value, but for example, the case in January, you definitely would not see cases of solar radiation at 7 a.m. in January, for example, in this case. So that all needs to be considered. You can tweak your calibration tools to factor in that deterministic essence of solar radiation or known profiles. And here as well, you can see the monthly average seasonality within your solar irradiation time series as well. So that's everything that is required for to get started with PPA valuation analysis. We basically use all those calibrated time series from the energy resources sources of wind speeds, solar radiation, paired with power price series of the respective German and Spanish markets, and run 1,000 simulations utilizing those, as well as calibrated volatilities, jumps, mean reversion rates. And we have then 1,000 simulations of hourly payoffs for the respective PPAs. You can see that here those hourly payoffs aggregated on a monthly level, and the solid line here is the average of those 1,000 simulations, so your mean or expected value on a monthly basis, as well as alongside a risk distribution of your 95th and 5th percentiles. So you can see the trends, the tightening of risk components there at certain months, and a clear trends which could link in parts to price seasonality, the forward curve structure, as well as the seasonality and the underlying energy source. So in this case, German wind seasonality as well. So this is your open unhedged PPA output on a monthly basis. We can aggregates the 5-year term, so the total expected payoff of the PPA across the 5 years, again through 1,000 simulations, and you can see a very wide distribution risk profile here, with your mean sitting in and around 3 million here, but you do have quite a range from your outlier events of minus 2.5 million or a positive 8.5 million. So quite a wide spread in your distribution risk profile across that 5 years for your PPA. Similar PPA is run for solar and the Spanish markets, again paired with the solar irradiation output megawatts conversion rate, as well as the paired Spanish power prices as well, with a similar wide distribution, perhaps slightly tighter just due to the fact that there's a bit less variability in solar profiles, and there's a bit more deterministic elements to it. But we still have a reasonably wide distribution profile, which again, depending on your role, well, most roles would look to avoid or source products to hedge against that exposure. So we now look at what hedging tools we can utilize to reduce that distribution risk profile of the PPA, and they can also not only reduce the risk but add value to your PPA portfolio. So the key to successfully hedged portfolio is understanding both the renewable energy sources dynamics as well as those of the respective power price markets. So our prior calibrations we've done an analysis not only feed to accurately reflecting the time series through our modeling, but also steer us to more effective hedging strategies. So the first hedging type or product type we look at is the baseload flat hedge. So this can be your calendar year flat price hedge. In all these cases, we're just hedging using swaps, basic swaps. You can go further and do more analysis at more elaborate product types such as options, look at put options, etc. But then there's a playoff with the liquidity in those products and whether you can structure them in the required way to profile against the risk you're looking to remove. So the baseload flat hedge is more suited to longer dated periods. So Viviana spoke earlier about the long dated PPA hedges that EEX offer that go at 10 years. So those are what's probably the tools best suited for longer dated hedges. There's less liquidity and more granular type products over those periods. So we're still exposed to seasonal price risk as well as intraday shape. For the seasonal price risk elements, we look to seasonal price hedges. So those could be your quarterly products, monthly products. So we just have a bit more variation in the strike price in our price hedging across the horizon. Again, that depends on at what point of the curve those products are available. So a lot of this tweaking of the hedging products with your more elaborate types of hedges tends to happen at the front end of the curve with your long dated baseload hedges at the back end of the curve for the later points of the horizon of the PPA. Baseload and seasonal prices addressing the sort of longer seasonal factor of price shape. We can look then at peak and off-peak hedging to capture and take into account intraday shape risk. And this needs to be specific to the renewable energy source we're looking at and its characteristics. So understanding calibrations and analysis we looked at earlier, we can then utilize that to optimize the structure of these peak and off-peak hedges. So for example, a solar peak volume hedge flat volume baseload hedge results in volume imbalances. So a solar irradiance has a bit more predictability profile to it, as we saw, such as, dark overnight. We can use that to our advantage and focus the hedges on peak periods only, where we know there'll be generation off of the PPA, which we can better profile match our hedges to. Alternatively, looking at winds, we may want to look at a wind off-peak price hedge. So unlike solar irradiance, wind speeds demonstrate less predictable intraday trends. Therefore, as opposed to matching volume on a profile hedge, we focus our attention on intraday price shape rather than on the volume side of things or the generation side of things. And the price shapes demonstrate slightly more definitive intraday characteristics than we saw with the wind speeds. In this case, our hedge is focused to protect the PPA from low price risk. Therefore, certain off-peak periods based on our analysis. So we can then select off-peak swaps in the case of our wind hedges in this case. And then the final hedge type is the seasonal off-peak hedge. So it's basically combining all of the above, the peak off-peak hedge, but then also the seasonal price elements components. So we're factoring ideally all the benefits of the above hedges into one ideal hedge. So to test those hedging strategies out, we again run the analysis alongside the hedges, again paired with the same power prices, wind speeds, etc., output volumes that the PPA is seeing. Output here, we're just again focusing on the first 2 years. Later dated years, we would use the simpler long dated, such as the 10-year, 5-year PPA products that are available via EEX that Viviana mentioned. But focusing our attention on the 2 years, we see the effects of the calendar year 2024 and 2025 baseload hedge. You can see clearly here that it's offsetting the periods in which the PPA is not performing so well, and then also vice versa, the PPA is outperforming and offsetting periods where the hedge is not doing so well. And I should have said this is again the expected or mean of the 1,000 simulations of our price simulations and wind speeds, etc., or in this case solar irradiance. Looking to add a bit extra value or reduce risk compared to the baseload hedge, we factor in the quarterly seasonal hedges. So you can see here it's adding a bit more value at the tail end of 2024 over the winter period and capturing a bit more value there, i.e. reducing a bit more risk against your PPA. And it's worth noting that we can just see sort of performance from it in the first calendar year, because we're now stepping into sort of the seasonal quarterly products, which are more liquid within the current front year that we're trading in. And then again, in later years, you'd look to your baseload products to hedge out. This is capturing the seasonal effects of the price shape throughout the year. We haven't yet factored in intraday. So we look now at the peak volume hedge we spoke about for solar irradiance in the Spanish market, and we can see extra added value here over the summer periods where we're focusing our hedges on volumes matching our peak profile that our PPA sees, and you can see slightly better performance there with a bit of a dip in winter, but hopefully offsets and exceeded by this extra summer performance. And we're basically just trying to etch away and reduce risk or add more value to our portfolio. And then finally, we have the quarterly peak volume hedge, which acts in the same way as our peak volume hedge in the summer, but then we capture more value or reduce more risk within the winter period with that seasonal component factored in. So each step we're trying to etch away or take a notch off of our risk profile for our PPA with those hedges. So this is the expected value of or the average on a monthly basis of those simulations. We then compare those hedges along all the 1,000 simulations and see how that distribution profile is affected. So firstly, we see quite a wide distribution as we saw with our PPA hedges earlier. And we layer in each of those hedges we saw on the last slide, but see the full effects on our distribution risk profile. So our baseload hedges, as we saw in the previous slide, anytime the PPA is underperforming, the baseload hedge is compensating for that and offsetting it, and vice versa. So that's why we have the tighter distribution. As the tradable products we're looking at are only liquid in the first year, this distribution is now just focusing on the first year only. So the reason it's shifting to the right is in the first year, the PPA is very much in the money. So we're probably looking at this with tinted lensed glasses. So what would be interesting would be is as you roll forward through the 5-year horizon, as the fixed price potentially becomes more at the money and tighter, how your distributions shift more to the left, and it's more difficult to manage that risk exposure to have a positive outcome. And then going through the same process, we layer in the different hedging techniques. So we now have the seasonal base load hedge and add in then the peak volume hedge. So you can see we're sort of etching away and again adding more value, reducing our risk to the PPA in our entire portfolio. And then finally we have our peak quarterly volume hedges. So these are the combined PPA and hedge portfolios and how the distribution changes over time with the different scenarios. So you can refine that, tweak volumes of the amounts you're hedging and iterate through the same process, or look at other available tradable products to utilize and run scenarios like this to fully understand what are the best hedges to make to optimize your PPA portfolio. It's very similar process for German wind, so I'll just go through that quickly. You see the same effects here of the baseload hedge and the seasonal quarterly baseload hedge as well, and capturing a bit more extra value. But however, for the peak or off-peak hedging, as we identified, wind generation intraday shape is less deterministic, so we focus on the off-peak price shape rather than the solar volume shape, and we can capture a bit more value across the board here, not just only in summer periods, and then we combine them all for off-peak quarterly price hedge. And again, we see similar distributions and the trend in the various different type of hedging techniques. We see wider distributions now, now that volumes uncertainty is not only confined to daylight periods that we saw for the Spanish solar. There's more of a switch when we look at these last two, because now they're only focusing on off-peak periods, off-peak prices. So that's, again, you can vary different hedging techniques and assess them and their distributions. But hopefully this has given you a good sense of the required steps of analyzing the PPA, the key considerations and the building blocks of the analysis, and then how you can assess the hedges and understand the outputs and the risks you're still exposed to after the hedges. So I'll hand back to Chris at this point to round up and maybe manage some questions that some of you have.
Yes, so thank you very much, Ronan. I have yeah, quite a few questions, so I've tried to group them together a little bit. So there's a couple of people have asked about getting the can you get a recording of the webinar? The webinars that we've done that have been hosted by EEX previously were published on EEX TV. So I think the same is going to happen here. That takes 2 or 3 days, I think, to do all the work in the background to get that up. But if you look on EEX TV, and we can email out to people when that's up, so you'll be able to see a recording of it. Some other people asked about, can you get a copy of the presentation? Yes, so the answer to that is yes. I'm going to put some email addresses of some of our people up and the presenters up afterwards. So if you email us, because otherwise we don't know who to email it out to, but yeah, anyone that's interested can get that. So those are just general questions. There's a couple here, Viviana, for you. First one is, I mean, you described some products on EEX up front. Who are the PPA hedgers on EEX?
Yeah, thanks, Chris. Hi, yeah, thanks, Chris. So the PPA hedgers on EEX, typically we've seen that utilities, which are our biggest client group in general at EEX, of course, are also very active in PPAs. Of course, they have a lot of renewable energy development, and they also have the capabilities and the know-how to do things like translate the wind and solar profiles into a baseload hedge. And they also hedge on a portfolio level basis typically as well. So they have quite large portfolios, of course, all across Europe and in these key markets like Spain and Italy. And they see the value in using the baseload for hedging, and also, of course, benefiting from the counterparty risk management at our clearinghouse ECC, which essentially acts as a risk transfer mechanism. We also have had a lot of intermediaries active, especially in Spanish power. So, for example, a bank providing indirect access to PPA hedgers, such as renewable energy developers who may not be direct members of the exchange, but can access through a bank. And these are also typically back hedgers, where they might just be placing a single deal or two per year and also per project. We also have several large industrials as customers who are large consumers of energy, and they would be hedging the PPAs as well.
Oops, sorry, my daughter ringing me. Okay, and then you know, we obviously saw what happened in last year around initial and variation margins. So how are, especially when we're dealing with these sort of longer term deals, how are trading firms coping with the potential liquidity risk for PPA hedges derived from both this sort of initial margin and variation margin perspective?
Yep. Am I live? Hi. So first of all, of course, any member of ours or indirect member trading on our markets and any derivatives markets has to take potential volatility into account. So this is something, of course, that is managed within the firm in the risk and treasury departments. And then there is an agreement with the clearing bank as well, or an indirect access provider. And in that agreement, there is also considerations to be made on how the cash flow and the collateral will be managed between the clearing bank or the access provider and the trading firm. So this is all done and slightly out of scope of what happens on the exchange. But then afterwards, of course, like I said, you can look up the initial margin values at the ECC on the ECC website prior to conducting one of these deals, which is typically what a lot of our customers do. So you know in advance what that will be and whether that is, you know, able to be handled in the firm. And then in terms of variation margin, Again, like I said, this can depend on the risk parameters that each firm has, and of course the market conditions. As we saw in 2022, there was almost no trading because it was so volatile. But now that prices and collateral requirements have stabilized, our customers are utilizing the full curve available. And typically what we see is that there is some volatility, of course, in the liquid short-term CALs, which impacts variation margin. But as we go out along the curve past Cal plus 3, Cal plus 4, the price movements day to day are very stable. And so the impact on variation margin is minimal.
Okay, thank you very much. And then there are quite a few questions around modelling. So and I can say a few things up front about this as well. So there are quite a few questions around how you calibrate models, how you link prices and generation levels, and one of the terms that Ronan used when he was talking was a term that I often use, which is calibration is part art, part science. So the science bit is you have a model that you think is a relevant model for that particular variable. It's typically written down as a stochastic differential equation. You discretize it up, you throw a bunch of data at it, and you do the regressions or whatever maximum likelihood or whatever calibration method you're using, and it spits out some numbers. So that's the science part. The art part is around, do you use 1 year's worth of data or 2 years worth of data or 3 years worth of data? And that's going to depend on what the time series dynamics look like 3 years ago versus 2 years ago versus 1 year ago. And so if you think that the market is changing, then statistically you say, well, you throw more data at it, you get a more accurate result. But if the market's changing, then throwing data in a calibration routine from 3 years ago, when you know that the market dynamics has changed over that period, then you're calibrating to sort of stale data. So one of the questions, Ronan, was you looked at historical data to conduct the calibrations. Essentially I can sum up a few of the questions by saying, well, what if you don't, the market's changing and is going to continue to change. What if you don't believe that the market acts like that anymore? So what can you do other than just throwing historical data at it?
Yeah, and yeah, that's a good point you've raised, Chris. So the fact that you spend all this time to get to a calibration you're happy with, and you can't just then leave it and automate that and trust that it fairly reflects the markets. The markets are changing, so with more intermittent generation in the markets, you are getting more volatile power price shapes. There's scenarios of wind cannibalization, where oversupply of wind, for example, has a downward dampening effect on power prices. Your intraday shapes change. So all of that needs to be factored. You can consider scenarios where you impose your own perceived intraday shape, for example, on power prices. You can even have things like wind speeds to price transformation models, so that factor in that wind cannibalization element. So your calibrations, as you say, and the structure of your calibrations do need to change as the markets change, and you can't just rest on your laurels that you've nailed a calibration for today. 2 years time or even 6 months time, it could be completely different in how you calibrate.
Yeah, actually, Ronan, I might jump in there because you just made a point, which is there's a series of questions that are very much related to this. There's a couple of the questions have alluded to the fact of, for the analysis you've run a relatively short period, because otherwise, there's just too much going on and your graphs a lot of the graphs wouldn't have made sense, but it's applicable over those longer periods. But the analysis is applicable over those longer periods. And there's I guess there's two important things. One is you said that this kind of analysis requires inputs around the current forward curve and shaping, and similar analysis around solar irradiance and wind speeds. We might not expect we might not expect wind speeds or solar irradiance to change very much, but if you're going to go out 15 years, we're using a period where there could be relatively liquid forward curves, or at least forward marks that come from EEX. But you have to put in information about what you expect forward levels to be over much longer periods, and we have to take into account I forget what term you just used, but essentially, as there's an increasing proportion of renewables in a particular region, then obviously, whenever the wind blows, I mean, typically I can think of certain regions where they're sort of in a relatively small geographic region. When the wind blows, all the turbines operate, and the generation levels go up, the supply goes up, and that obviously has a dampening effect on the power price. So there are in the analysis that we do, we're pretty we can be relatively general about how we link variables, and the simplest thing to do is just to link them via correlation. But if you really want to take into account these effects, then you have to go the extra step and say, well, we want to use a transform function or use a functional relationship between the fact that as the wind generation goes up, the power price comes off. So and in terms of answering the question, there are a number of different ways of doing it, but it is obviously an important thing to take into account. If you're just trying to model power prices and generation via some link with correlation, that's a poor way of doing it. If you believe that the predominance of wind is going to have an effect on the power price, so you do have to. We've talked at a relatively high level within this webinar. But there are these types of things you have to take into effect. We take into effect by transform functions. We have to rely on forecasts as well as market data as a sort of best guess about where the forward levels are going to be. All of these things are practical considerations to take into account when you run the model. So I've just been reminded that we're coming up for 1 hour. So I'm just going to end with two slides really. I'll skip 24. If we go on to, oops.
Oh, sorry,
okay.
I switched to
all right.
Let you control, but I can.
I'll share. So okay. There is a slide in here as to. Can you see my slide?
No, we can't.
I think I've shared. Yeah, okay. This slide is just in there. If you want to talk to us about any of the things that we've been talking about within this webinar, we've obviously generated it with our own solutions. We're happy to talk through that. If we haven't answered your question, and there are lots of questions that I haven't had time to get around, can you just, and some of them are just, it just says anonymous. Can you please just email us directly the question, and we can attempt to ask that via email. I'll give you some email addresses at the end. If you're physically located in Europe and you're going to eWorld in a couple of weeks' time, then Viviana and two Lacima people will be on the EEX booth, which is in Hall 3. I don't know what the plan is this year, but typically it's got good food and good coffee, which are ideal attractions to go and see the booth, as well as seeing Viviana and Stephen and Sylvester, who are will be Lacima representatives that will be there. So if you have any, and I apologise if you can get around to all the questions. We had 415 people on the webinar, and we've got quite a few questions. I haven't managed to go through them all and publish them because we didn't have time. Viviana, myself and Ronan, our email addresses are there. Representatives on the sales side from Lacima, the two people who will be eWorld in a couple of weeks' time, Stephen and Sylvester, please email them as well. I have said email us if you want the presentation. We'll send the presentation out. There are two. There's a link to our website, and there's a link to Viviana giving some presentations and some background material for PPA hedging on the EEX website. So feel free to get in contact with us. Thank you very much indeed for your attendance. Thank you to Viviana and EEX for the ability to be involved in this. And have a good day, everyone. Good evening if you're in similar region to me. Thank you very much for your attendance.